Good morning, everyone, and welcome to Bloomberg UK. I'm Francine Lacqua here in London. Now, today we focus on the UK economy through the eyes of two business leaders who operate in different parts of the economy. But first, let's take a look at the latest forecast for the economy. Now, Bloomberg Economics has scrapped its previous forecast for a recession and now sees the British economy stagnating this year with a full-year GDP growth at just 0.1%. Now, on a monthly basis, UK GDP actually rebounded in January, following a contraction in December. Meanwhile, policymakers are keeping an eye on the banking crisis. That, along with slowing wage growth and tightening financial conditions, will weigh on thinking at the Bank of England. Bloomberg Economics expects the Bank of England to hold its rate at 4.25%. However, BOE chief economist Hugh Pill is warning that the terminal rate may need to go higher to prevent price pressures resurgence. Now, the most recent readings also of UK inflation have surprised to the upside, hitting double digits again. It is, however, expected to drop sharply this year, particularly due to a drop in energy prices expected after July. That's also the view of the Chancellor of the Exchequer, Jeremy Hunt, who delivered his budget last month. Now, Bloomberg Economics believes that the effects from his policy would be broadly offset by financial tightness. Well, let's get onto all of this, analyzing Reed Recruitment's job vacancy numbers. Bloomberg has found that Manchester, the former industrial powerhouse of northern England, has become an employment hotspot in what may be an early victory for the government's levelling up program. So to talk a little bit about what business have been battling, which is severe worker shortages with high demand for staff fueling the strongest wage growth and a record outside the pandemic. We'll look at the labour market. We'll also look at some of the company's necessities going forward, including some restructuring. So let's bring in our expert panel. We couldn't be more excited that bringing these two gentlemen together. James Reed, Chairman of Reed Recruitment. Every month, Bloomberg now uses their numbers to produce readouts on the state of the UK jobs market. Also here with us, Simon Freakley, Chief Executive of AlixPartners, a financial advisory and consultancy firm. So thank you both for joining us. James, let's start off with you. You're in the jobs business, and we know that businesses are struggling to find staff. Is it getting a little bit easier as the dynamics of work are shifting?
We're seeing a slight change, Francine, but only a slight one, because job numbers, vacancies are still very high. And this has surprised a lot of people who were expecting a recession, and one, as you just mentioned, hasn't appeared yet. So vacancies are still very high, and there are great shortages of skills right across the UK economy. So every sector really is struggling to hire at the moment, and I can't see that changing quickly.
I mean, how do you see the economy changing, Simon? So you advise clients, it's either restructuring or actually how to get better return for shareholders and also for their staff. What's the situation like right now in the UK?
I think it's very challenging for executives in companies. I think it's a time of profound disruption. I think all of the things we just talked about, tightness of the labour market, inflationary pressures, the cost of living going up significantly. I think these are very, very pressurized time for companies, and I think the key is that they have to lean into the transformation of their businesses to be fit for purpose.
But James, it's very exciting actually now that Bloomberg's analysing your data, and you see bright spots, for example, in Manchester. So there are places which in the past we said, look, levelling up just hasn't really worked. You see a pickup in jobs there.
Yeah, I think it's interesting. Businesses have to think much more carefully about where to locate, particularly to attract people. That's become a primary driver of decision-making about where you're going to locate your manufacturing facility or even your services. And so Manchester's proven to be a good location, and it's and I think it surprised some people. That's come out as the top location for new job creation, way ahead of London, interestingly, in the data that was analysed. And I think that could be the beginning of a trend, but there's a lot more work that needs to be done for levelling up to really happen.
So James, what surprised you when you look at the data? Is it that companies say, look, I can hire in Manchester because there's not the working from the office culture that's changed and I pay them cheaper, or is it actual businesses that are shifting to places outside London?
I think two things are happening. I think people are shifting, so businesses are shifting because they can get cheaper property, better access in other parts of the country, but also workers are moving because they can work remotely. So a lot of jobs that used to be just London-centric can now have much bigger catchment area. So you can hire someone in Manchester who might come to London once or twice a week, and it works very well for everyone.
So, I mean, do you see a similar pattern that actually, I mean, I know a lot of the big companies are still headquartered in London, but you see a shift on also how they service the rest of the country?
Absolutely, Francine. And I think coming out of this once-in-a-100-year pandemic, we've sort of got used to hybrid working in a way that's probably going to reset what the normal is. And so it is more possible, as James says, to spend a couple of days a week or a day a week coming to London and being based in the northwest or the northeast. So I think that actually physical location is less important. Companies have to take themselves where the talent is. And if that means some version of hybrid working in the long term, so be it.
Okay, I'm going to ask you both like rapid fire questions. Are you more bullish or more bearish on the economy than you were 6 months ago?
More bullish.
The same.
Same. I mean, I'm going to find something that you actually disagree on.
No, I mean the same as 6 months ago, because I wasn't bearish.
Same as 6 months ago.
Yeah, because our data wasn't bearish 6 months ago, and it's not now.
But so how do you see, I mean, if you look at the dynamics of, wage pressure, wage growth, also possible policy mistakes from the Bank of England, like what could go wrong in the economy and what could go right?
Well, there are lots of mistakes that could happen, and some mistakes will happen, I'm sure. But I think overall the impetus isn't as bad as it was, and what could go right? I think inflation will come down. I think it's going to come down more slowly than is expected, but it will come down. And I think confidence will slowly return to the economy, and it's more robust really than a lot of people credit it for.
Why are you more bullish, Simon? So, and I remember in December, I think we tried to, we got you on, and it was like, are we going to see zombie companies? Is this really it because of the energy price?
Yeah.
Was it because we thought at the time that it was the end of the world? It hasn't been the end of the world that you're now more bullish.
Right. I'm more bullish for a few reasons. First of all, I think we have a grown-up in the driving seat. I think Rishi Sunak is actually doing a very good job. And even if in due course we end up with a Labour administration, there's another grown-up waiting in the aisles. So I feel more bullish about the stability. I feel more bullish about how Europe is coming through this profoundly disrupted time, not just COVID, but this human disaster of a land war in Europe. I think the supply chain that's been such a challenge for business executives, people have now got strategies just in case, not just in time. So I feel that people have pivoted well, and that's why I feel more bullish.
But when a chief executive calls you up in distress and saying, Simon, I need help on this, do they worry about inflation or supply chain or see something else?
All of the above. They're kept awake by all of these things, but central to every single conversation is an anxiety that their businesses are not changing quickly enough. We do a survey every year, 3,000 executives around the world. The UK is the most disrupted country other than China and Japan, but everybody is worrying that their businesses aren't transforming quickly enough.
Yeah, and James, to that point, when you look at hiring, so are there industry groups that are naturally hiring more just because they're booming in the UK?
Well, interestingly, automotive has really come up as a big sector. Technology is continuing to be, and energy. So, I mean, those are pointers to what is coming, I think. Now, education is also really busy, and that's a factor, I think, of a lot of turnover in education and a lot of turmoil around wages. So we're seeing a lot of jobs in those sectors.
And is this foreign companies hiring or investing more in the UK, or is it homegrown companies?
Both. I mean, they're typically homegrown. I mean, there are more jobs being created domestically than by companies coming into the UK by a distance. But there are plenty of vacancies. I mean, we've seen vacancies come down year on year. They're down 14% year on year in the first quarter. But that's not that surprising, because last year there was this huge jobs boom following the pandemic. So it's not a big crisis in the labour market, and wages are going up, but they're not keeping up with inflation. Our wages advertised are up 7.7%. But some sectors, and I think this is really interesting, some sectors are paying ahead of inflation, and they're the sectors where people have to attend in person. So things like manufacturing, retail, customer service jobs, where you have to be there in person. Companies having to pay a premium to attract those people now, because so many people want to work flexibly.
Do the chief executives you speak to, Simon, worry about having to, the wage spiral, or are they pretty happy in matching inflation or even going above inflation, as long as they can then pass on some of the higher pricing to their customers?
They absolutely worry about that, Francine. And of course, because the cost of living has risen so significantly, it's become very real for people. But what we see, and be interesting whether James sees the same, is that whilst the labour market is tight, the skills market is even tighter. So the critical skills that companies need to pivot their strategies in the way they do, which is largely digital but not exclusively digital, those skills are in incredibly tight supply. There just aren't enough people. And so people are having to deploy other strategies, recruiting great raw talent and giving them very specific and accelerated training, looking at how people can retrain themselves. The half-life of a skill set in a white-collar job is thought to be 3 to 4 years. These are all strategies people are worrying about.
Yeah, can you accelerate actually some of the reskilling, James?
Was it on that technology point? It's interesting because there has been a drop in the number of technology jobs, I think because of all the redundancies that big tech firms have made. So it's actually getting slightly easier to attract tech talent because there's more people on the move. So that's a positive. Reskilling takes a long time. But I think finally the serious sort of government interest in supporting that and lifelong learning accounts, etc., are sort of back on the agenda. So I hope that there'll be a sort of government business alignment there to help more people learn new skills that they can then use effectively at work.
Okay, well, thank you both for joining us. James Reed, Chairman of Reed Recruitment, Simon Freakley, Chief Executive of AlixPartners, both stay with us, and we'll probably ask ourselves, can international trade also help rebalance the UK economy? We'll talk about growth next. Stay with us. This is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, we've discussed the problems of the UK economy and the jobs market, with critics of the government saying there hasn't been a concrete strategy for sustained growth. Now, let's bring in our expert panel again. Simon Freakley, Chief Executive of AlixPartners, also with us. James Reed, Chairman of Reed Recruitment. So thank you both for staying with us. James, you believe that actually we should pay staff more. Is this for retention, or is this just because with inflation going high and the cost of living crisis, you can't afford to lose the good people?
Well, I think many companies are looking at what they need to do to retain people, and paying people more is an obvious one. And wages have trailed inflation, and so real wages have been really squeezed. So this period has not been a recession, but it's been a really tough time for a lot of workers who've seen their wages squeezed. And we've seen real growth in disputes in the UK with strikes as a result of that. My view is that employers should take a generous view and should seek to pay people more wherever they possibly can in this environment, which might be controversial in some quarters. But I think over time, workers have had a worsening deal, and that's been to the detriment of business more widely and the economy too. So the national minimum wage in the UK has just gone up to £10.42 per hour. I think it should go up higher, but that's a 9.9% increase, which is a start. But I think that there should be a real emphasis on paying people properly and making work pay. I think that's important for a dynamic economy.
And Simon, this is probably one of the most difficult decisions, right, for chief executives, is how do you retain talent? How do you look at your cost base with people, paying more? Do chief executives tend to overthink looking at balance sheet and complicated things, where actually really they just need to keep the good people that work for them?
Well, that's certainly part of it, but Francine, as we know, that the most significant driver of equity value growth is revenue growth. Now, that revenue growth, of course, has to be supported by a workforce, the recruitment of good people, the retention, critically, of good people, which is why rates are so important. But that can't be at the expense of margin. So I think for chief executives, it's a matter of how you recruit the best people, retain the best people, but also protect margin by thoughtful strategies in terms of growing the business and ensuring that performance is not depreciated as a result of that.
So what's their biggest mistake when you speak to chief executives?
Their biggest mistake is just focusing on one thing at a time. That actually there are several things that have to be focused on. Investors do require equity growth, which requires revenue growth. You have to have a talent strategy. You have to have a fair pay policy that incentivizes people to stay. It's looking at all those critical elements at once.
And James, again, when you look actually at a lot of investors looking at the UK saying, look, sterling is much more stable, the government is much more stable, I want in. The question is, how does the UK grow in the next 4 to 5 years? What would be your blueprint for this country?
I certainly think there should be a workforce strategy. I mean, that's a limitation on growth, is the shortage of skills. So that could apply to revamping the apprenticeship system, adult skills system, and there's beginning to be a serious attention on that. But I think a workforce strategy would be very important. And then a strategy that encourages the development of clusters of expertise. So we see that in places like Cambridge, where science and technology has really grown. There are a lot of new jobs being created in Cambridge. And there are other opportunities to do that around the UK, I believe, so that the growth is more widely spread and not too concentrated in the southeast of England.
But whose job is it to reskill? Is it private companies? Is it public companies, or private-public partnerships?
Well, ultimately, it's everyone's. I mean, it's down to the individual in the end. And we're seeing a lot more individuals coming online to learn new skills at their own expense. But companies are increasingly beginning to finance that. So they'll give people a check and say, spend this on something where you'll learn a new skill or get a new qualification to improve your performance in the job. And that sort of fluidity, I think, is very important, so it's not too rigid. But people want to learn new skills because they know that in this cost of living crisis is a way of getting more income. So people are keen to do that.
Simon, how would you grow the economy?
Well, I think there's another dimension to this, which is how to look at human capital and actually get the benefit from technology and greater productivity. Because ultimately, whilst I support obviously paying fair wages, that has to be driven by productivity. So how do we get productivity? It's the fusion of human capital and technology. There's been great examples recently. BMW, for instance, showed that by actually joining human capital and better technology, they had 60% increase in productivity. It's the key.
Does AI and ChatGPT make us better? Does it help with productivity?
AI and ChatGPT and similar generative AI tools are going to be absolutely critical to every thought worker's job. I think it'll help and support rather than replace. So I think there's a whole new revolution about to start.
But James, at the same time, so many people are saying, like, look, we don't know what we're exactly dealing with. We don't know how many jobs will be lost because of these new technologies. How would you view them? And actually, if you were just to give a piece of advice to someone who's getting into the jobs market now, is it the human skills or is it the AI skills that are needed for the jobs of the future?
The ChatGPT thing's exciting, I think, in many ways. And I was talking to a young woman who's setting up her own business, and she went on ChatGPT and asked for terms and conditions that would work for her sector. And she had it within a minute, and it saved her a lot of time and money. So I don't know how good the terms and conditions are. I would suggest you got it checked. But I think that's interesting, and I think it can, it can enable a lot of new activity. And I've been sort of running a recruitment business for a long time, right from the beginning of the World Wide Web and the internet. Yeah. And all these developments have created jobs over that period of time. So I don't approach it with fear, but more with a sense of opportunity.
But they've changed jobs so much.
Sure. Right? I mean, who knows what jobs we'll be doing in 20 years' time?
Do you need to start thinking now? Do universities need to start thinking now about how they train the workforce of tomorrow because of these societal changes?
Well, I think a lot of it's about being flexible, isn't it? So being agile and responsive to the changes and committing as individuals to a lifelong learning sort of curriculum. Yeah. We used to think when we finished at school that was it, but it's not, is it? So it keeps going. And so, the businesses used to want certainty. Well, the one thing they're guaranteed is they won't have that. It'll be uncertainty. And people used to think that learning was done in a formal setting when it's not. And I think that's a total change. And we're still getting to grips with it.
But that's hard, Simon.
It's hard, and I think critically, when I talk to chief executives every day, the pressure on leaders now to lead their businesses, lead their workforces through this period of profound change is extraordinary, probably under more pressure than they've ever been before, having to do things nearly right but do them now, and staying agile, as James says.
So who's the ideal chief executive? I mean, it seems like it's a renaissance woman or man, right?
I'm not sure there's an ideal, but I mean, give you an example. I think Simon Roberts has done a fantastic job at Sainsbury's, how they've gone back to basics, how they've really got that business reformulated and back on its front foot. A great example. Yeah.
Well, thank you both. Our expert panel talking about the future growth for the UK. James Reed, their chairman of Recruitment, Simon Freakley, chief executive of AlixPartners. Now, also, the Good Friday Agreement, often held up globally as a model for peace and reconciliation efforts. So we take a look next at the legacy of the treaty and what it's meant for Northern Ireland over the past 25 years. That's next, and this is Bloomberg. Next week marks 25 years since politicians signed the landmark Good Friday Agreement in Belfast. It changed the course of Northern Ireland's history, seeking to end more than 30 years of armed conflict known as the Troubles. Louise Moon explains the legacy of the agreement.
25 years ago, politicians in Belfast signed the Good Friday Agreement, officially ending more than 30 years of conflict in Northern Ireland. Known as the Troubles, around 3,500 people were killed in violence including bombings and rioting. the prospect of peace and a stable, devolved government was met with overwhelming support. Tony Blair, Bertie Ahern and Bill Clinton played a key role in helping hammer out the agreement. It was based on power sharing between mostly Catholic nationalists who favoured independence and Protestant unionists wanting to preserve ties with the UK. But the journey hasn't always been smooth, and distrust remains, along with continued instances of violence.
We are dealing with a divided society. We wish it wasn't, but it is. And, you know, it's going to need tender and open care for a long time.
The Northern Ireland Assembly at Stormont has been unable to function for 40% of its lifespan due to disagreements between the sides. Most recently, the Executive Committee hasn't met since February 2022, discourse spurred in part by post-Brexit trading arrangements. While not suspended, no major decisions can be made. But despite many continuing challenges, optimism remains.
Whatever the problems in Northern Ireland, what people should never forget, it's a world better from where it was. And if we exercise common sense and realism today, we can keep the peace intact.
Well, that was Bloomberg's Louise Moon on the Good Friday Agreement, which will be the focus of next week's UK show. And US President Joe Biden will visit Northern Ireland and the Republic of Ireland next week to coincide with the 25th anniversary of the signing of the Good Friday Agreement. The trip to Northern Ireland will be to mark the tremendous progress since the signing of the peace treaty and to underscore the readiness of the United States to support the nation's vast economic potential. Well, Biden will first travel to Belfast in Northern Ireland from April 11th, then to the Republic of Ireland 3 days later. Be sure to subscribe to Bloomberg's Also in the City podcast. Join me and David Merritt on Apple Podcasts, Spotify, or wherever you get your podcasts. New episodes drop every Thursday, and this week we speak to legendary investor Jim Mellon, who predicted the financial crisis. He tells us why he's so bullish about investing in the UK. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller in New York, Danny Berger here in London, and this is Bloomberg.